Economists refer to a firm that subtracts value whose cost of equity capital, also known as opportunity cost or implicit cost, is greater than its accounting profit as having negative economic profit. What that means is the owner of this firm could have earned higher return elsewhere. Okay? So the resources and the skills that this firm puts into this particular business could have generated better return elsewhere. A firm that neither adds nor subtracts value is the firm whose accounting profit is sufficient to pay the cost of equity capital, but generates nothing in excess of this. This result is referred to as zero economic profit. So what that means is the firm could not have done better elsewhere with the resources and technology. Okay? It could not have done worse either. Okay? So this firm is indifferent between staying in this business or elsewhere or other alternatives. Lastly, if a firm is returning more accounting profit to its owners than the owner's cost of equity capital, the firm is said to be earning a positive economic profit. So the resources and technology, the resources and the skills and the technologies firms puts into this business is best used in this business. Okay? So the return is superior to other alternatives. When a firm earns a positive economic profit, investors in a firm are earning better returns than they normally would with competing investment. As a result, other investors will want to invest in firms too. Resources will flow to where they earn more. Okay? So normally when we see an economic profit in a company or an industry, then we will see investors, outsiders coming in, wanting to take a piece of this economic profit. So now let's turn to some of the calculation or the technical parts. Total revenue. So profit is total revenue minus total cost. Total revenue, so shorthand as TR, is the proceeds of selling goods and services. So it's price per unit multiplied by the quantity sold. Total cost is simply the market value of all inputs used in the productions of goods and services. Okay. So let's do a little bit of calculation. So in this particular example, you are given the quantity of output, the price, the total revenue, the total cost. So let's find the profit. Why don't we pause for 5 minutes, okay, and do some calculations. So let's pause for approximately 5 minutes and come back. So we'll come back. So I'm sure you have done your calculation. So the calculation is pretty straightforward. So the profit is simply total revenue minus total cost. Okay? So let's do a few of the calculation. Total revenue minus total cost. Okay, one more. Total revenue minus total cost. So we have found the profit. When the company sells nothing, the total profit is negative 1,000. So that's a loss. So 1, the total profit is 300. Okay. Negative 300, again, that's a loss, and so on and so forth. Okay. So when you look at the profit, which one use the highest profit? So let's recall the primary objective of a firm, by our assumption, is to maximize profit. So which level of output use the highest profit? Okay. Most of you probably can find 7 units or 8 units. When the company produces 7 units or 8 units, it uses the highest profit, $3,800. Okay. So a company should produce 7 or 8. However, in this course, we do not want to rely on the calculation of total revenue and total cost to determine the level that a company should produce. There's a couple of reasons for that. First, when you look at this calculation here, there are only 10 data points. In real life, we deal with a lot more than 10 units of goods, 10 units of quantity of output. So we deal with a much bigger data set. Okay? So the calculation like this could be tedious. Another reason that we don't want to rely on this method is that, well, when you look at this, we have all the actual data, the total revenue and the total cost. But when a company, in reality, when a company tries to determine how much to produce, it plans ahead. So that means we don't have actual data like this. Okay, we don't have the actual data of total revenue. We don't have the actual data of total cost. Okay? So what we have here is an estimate. So how do we estimate the future total revenue and the future total cost? Well, in larger companies, a lot of these larger companies collect historical data like this. Okay? And then from this historical data, they can estimate a total revenue function and a total cost. Okay? So from there, they can estimate what we call the marginal revenue and marginal cost functions. Okay? So mathematically, when the marginal revenue is equal to marginal cost, then we can get the maximum profit. Okay? So obviously we're not going to linger on why when marginal revenue is equal to marginal cost, we get the highest profit, because that requires some, at least, some kind of calculus, which is not what we required here. Okay, so we're just going to take it as given. Okay. So so the story in short is, we are going to use so-called marginal analysis to find the level of output that will maximize the profit. and later on minimize the loss in some cases. So let's refresh our memory. Okay, so we have talked about marginal cost before. Marginal cost is the additional cost of producing one more unit of output, whereas marginal revenue is the additional revenue from selling one more unit of output. So here's a mathematical formula. Marginal revenue is simply the change in total revenue minus total quantity, minus the change in quantity of output. Marginal cost is simply the change in total cost divided by the change in quantity. Okay? So when the marginal revenue is greater than marginal cost, the company should continue to increase quantity. Because when you think about this, when marginal revenue is equal to marginal cost, each additional unit that this company produces will generate more additional revenue than the additional cost that it incurs. In other words, this additional unit of output can generate what we call the marginal profit. It can add to the total profit. When the marginal revenue is less than marginal cost, the company should decrease quantity. Okay? So when you think about it, when the marginal revenue is less than marginal cost, what that means is if this company produces one more unit of output, the revenue that this additional unit brings in is not enough to offset the additional cost that it incurs. Okay? So that means by producing this additional unit of output, this company actually is incurring additional loss. It will eat into the profit. It will reduce the profit. Okay? So therefore, the company should decrease quantity. Profit is maximized at the output level where marginal revenue and marginal costs are equal. Okay? So this is one of the very important so-called profit maximization condition. Okay? I do not like the term profit maximization because very soon you will find out that sometimes companies are incurring a loss, but by doing this, by producing the output where marginal revenue and marginal costs are equal, they are actually minimizing loss. So I prefer the word optimal, okay? But obviously profit maximization output level is commonly used. So let's do a little bit of calculation. Okay? So let's go back to the same example. Okay? Same example. Okay? So by using marginal revenue and marginal cost analysis, let's see whether the result is any different from what we have found just now. So let's first find marginal revenue and marginal cost. Let's take a pause here, 5 minutes, and try to do the calculation. So let's take a pause here, 5 minutes. Let's try to do some calculation. Okay, so when you look at the marginal revenue, let's do a few examples before we move on. Okay, so it's a change in total revenue minus the change in total revenue divided by the change in quantity. Okay, so the marginal revenue of the first unit is 1700, right, minus 0, okay, right, minus 0, and then divided by the change in quantity, okay, so 1 minus 0, okay, so 1 minus 0. Okay. Right? So one more, the marginal revenue of the second unit of output, how much the second unit of output adds to the total revenue. Once again, the change. So that's the change in total revenue. The okay, 3300 minus 1700. Okay, so that's the change in total revenue divided by the change in quantity. Okay. All right. So one more. Okay. The marginal revenue of the third unit of output. Okay. So that's 48,000. Once again, the change in revenue. So 48,000 minus 3,300. Okay. And then 3 minus 2, the change in quantity. Okay. Right. Okay. So the same for marginal cost. Okay. The marginal cost of the first unit of output, that's the change in total cost, 2,000. Okay, so 2,000 minus, sorry, divided by the change in quantity. So 1 minus 0. Okay. One more time. The marginal cost of the second unit of output, that's once again the change in total cost divided by the change in quantity of output. So 2 minus 1. Okay. All right. Okay. So one last example. The marginal cost of the third unit of output, so 3,500. Okay. Minus 2,800 divided by 3 minus 2. Okay. All right. So we got the marginal revenue and the marginal cost. Okay. You want to make sure that you know how to do the calculation correctly. Okay. So if you did not complete the calculation just now, then you want to shut this off a little bit or close it down a little bit so that you can do the calculation yourself and then match your answers to the ones on this slide to see whether you got it right. Okay. So now we have gotten marginal revenue and marginal cost. So you can see that at 8 units, the marginal revenue is exactly equal to marginal cost. So according to marginal analysis, okay, the unit, the quantity of output that meets this condition, where the marginal revenue is equal to marginal cost, should give us the highest profit. So this is exactly what we see here, $3,800. So this company should produce 8 units. So in some cases, when we don't have a perfect condition like this one, okay, we will settle down for the condition in which the marginal revenue is greater than marginal cost. Okay, so this is when we don't have this condition. Okay, but in this case, we have marginal revenue equal to marginal cost. So 8 units is the profit maximizing condition. Okay, so profit maximizing output is 8 units.